Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm speaking to you from New York City on this, the 10th day of October, 2017. Before I talk more about today's show, let me remind you that I am the editor of Jay Taylor's Gold, Energy, and Tech Stocks, and that you can subscribe to that letter by going to miningstocks.com, or you can call our office during normal work hours in New York at 718-457-1426, 718-457-1426. And as usual, I like to encourage you to consider subscribing to Chen Lin's letter as well by going to chenpicks.com, chenpicks.com. Chen has done an exceptionally good job of making money for his investors, having one account that I'm familiar with. He took $5,400 in 10 years, turned it into $2.5 million. Not too bad. I wished I could do that well. Well, Chen shares some of his ideas along with his subscribers, so you might want to consider going to chenpicks.com. Hope to have Chen on the show sometime in the not-too-distant future as well. I want to thank each of you for listening to this show, making it one of the more popular shows on the Voice America Business Channel. Also want to invite you to keep your questions, criticisms, praises, and whatever, keep them coming to questionsfortaylor@gmail.com. Questions, the number 4, Taylor at gmail.com. We do want to thank our sponsors for making this show economically viable. Our sponsors for today's show are New Range Gold Corp, Klondike Gold Corp, RN Resources, Novo Resources, and Genesis Metals Corp. Now, next week, Robert Carrington of New Range Gold Corp will be my guest. He has an exciting high-grade discovery in Nevada that I think you'll want to hear more about. And then in 2 weeks from now, October 24th, Dr. Quentin Henning of Novo Resources will be on the show to update us on what is considered by some to be one of the most exciting new gold discoveries to come along in quite some time. And speaking of Novo Resources, I have titled today's show, Novo Resources, the greatest gold discovery since 1886, ? Brent Cook, John Kaiser, and Michael Oliver are my guests today. Novo Resources is a sponsor to this show, as I just noted, and it's seen its share go from about 83 cents in Canadian money on July 10th to $8.22 when I looked a little earlier today, right an hour or so before we went on the show here. Visual reports and early sampling have revealed a rich field of near-surface gold nuggets in northwestern Australia that reportedly appear over an 8-kilometer strike length and may extend, I emphasize that, many kilometers down dip. In quest of the next Witwatersrand gold deposit, from which over 35% of the world's gold has been mined throughout history, Novo's Dr. Henning exercised his geological theories, and that led him to this discovery. But has Henning actually discovered Witwatersrand 2.0, as my guest John Kaiser likes to refer to it? If so, is a current market cap of nearly $940 million justified? Well, both Brent Cook, he's an astute geologist, and John Kaiser, an experienced analyst of exploration stocks with a focus on out-of-the-box geological theories, both of those gentlemen visited this exciting new discovery in northwestern Australia a few weeks back. We'll ask both of them to talk about their thoughts on this very unusual gold deposit and whether they think it has the potential to be an extraordinarily significant discovery, and also what some of the risks may be for those who buy the stock at current levels. As in most often the case, almost every week, I'm delighted to say I have Michael Oliver with me to give his latest thoughts on the markets that are of most importance to our listeners. Thanks for joining me again, Michael.
Great to be here, Jay.
Always good to have you, and I always want to tell my listeners that your website is olivermsa.com, olivermsa.com. Michael, in your weekend missive, you did something that is quite unusual for you. You actually showed a price chart for gold, but no momentum chart to go along with it. Normally you have the price chart at the top, and then a momentum chart below. What are you trying to say, Michael? Are you suggesting that even price chart technicians can see a gold bull market on its way?
Yeah, I think the momentum is spoken pretty much. I mean, when you measure momentum, what you're doing is you're taking a price and you're measuring it not against the dollar units on the left scale, but against certain means or moving averages. So when I use long-term moving averages like a 3-year or 36-month or a 3-quarter average, and I measure gold price against that, I get a different visual view of the gold trend. Okay. those oscillators broke out starting in February of 2016, and it basically broke it out over everything I can find to break out above. Okay, so they're through. They're saying, okay, we're gone. The horse is out of the starting gate. Price is lagging normally in trend changes. Price action will lag, whether it's a top or a bottom, in terms of saying, okay, I've broken out also. Well, if you look at a gold chart going back to 2013, after the crash that occurred between April and June 2013, gold went from 1,600 to 1,180 in 3 months. Okay, that basically cleaned up the bear market that needed to occur. After that crash, there were rallies. And if you plot a trend line on a simple price chart across the rally high weekly closes or monthly closes, whatever, during that period, several-year period, there's a fairly flat line. And the high we made about a month ago, intra-week, was 1358, and the weekly close is in the 1340s. If you ever close a week out, 1350 or higher, I'm going to break that trend line out that any price chart guy could plot. Mm-hmm. And at that point, the price chart folks are going to say, hey, this is a major breakout of a massive multi-year wide base. Now, admittedly, it's a couple $100 after momentum already said to buy it, but still, it is a breakout. And momentum agrees with it because momentum is already positive. So I'm saying now the only thing to look at now is not momentum. Momentum's spoken. Price is the one to look at. And it says you get back up there one more time above that 1350 level and close a week there. Assume it's ready to launch. Mm-hmm. And if you measure the depth of that price chart base, like an orthodox price chartist would do, it's like a big head and shoulder bottom, big convoluted thing. It says 1,700 is the first swing objective. And I have no argument with that. So, but anyway, right now I'd say watch 1350. In other words, go back to that recent high we made and close a week up there. And even the price folks then should be pounding the table saying, oh golly, this is really a bottom. And
all right, well that's we'll keep our eye on that, Michael. Yeah. That's certainly music to my ears as a gold bug. But let me ask you, just turning with a couple of minutes only left yet here, let me ask you about the S&P, the equity markets. You showed a series of price and momentum charts for the S&P index in your weekly letter, your weekend letter, and you compared, or you looked at several key periods of time, like 1971, 1974, 1984, 1987, 1999, 2001, 2005, 2008. Are you drawing some comparisons to the present time with those eventful
one
periods?
Of those tops, the 87 top, was a crash, of course, but that was rare. Normally, when you top out the S&P, it takes a year and a half of topping action, where it's grinding. It may be making new highs, but it's doing it at an incrementally lesser rate of increase than it had a year before, let's say. That shows up on the momentum charts, by the way. And so it's what I call arduous top. And I think we're in an arduous top. And I think the S&P right now is at 2548, I think, as we speak. The NASDAQ 100 is weakening relative to the S&P over the last month or so, which is an important factor. But if the S&P would drop about 2%, you drop down to about 2503, I've got a number there. As far as I'm concerned, you probably put your top in place, and you're going to wobble hard between now and the end of the year. Nothing serious, no 10% drop or anything like that, but you're going to probably have made your top and fall off the high of the year, still have an up year. But nobody will be too concerned. But the problem is if you do that, if you do drop a couple percent from where we are now, you set in motion, I think, the beginning of the major decline. And that the real decline won't show itself until next year. That all you can do this year, hopefully, is to kick it in the shin and watch it wobble. Okay? And then next year, the floorboards can come out. But not this year. But right now, all I'm looking for is the hard wobble of 5% or so, and end up the year yawning off the highs, and then next year they take it down.
All right, Michael, 30 seconds. Do you think a major decline in the equity markets will impact gold shares negatively?
No, I don't. I think it'll help gold. I think one of the things that'll help gold is if you take an asset category and make it not taste good anymore to investors. Bad biofeedback, where they don't get rewarded anymore, and a lot of people are skeptical of stocks anyway. Non-gold stocks, the regular stocks. And if you kick them in the shin, and we drop 5 or 6% off the high, and then they look at gold, what gold's done since the close of 2015, they're going to see gold beat the S&P. In fact, I think it's beating it right now, measured against 2015 close. And therefore, what feels better is you move over to gold. And I think the wobbling in the equity asset category will be a shift in investor preference. And I think that's a fundamental that will help gold because it simply moves money from one area to another, from what doesn't feel good anymore to something that feels better. Simple as that.
Right. Well, you do have a way of simplifying things, and it certainly has been a wonderful help to me. Your momentum gauges have worked extremely well, so I thank you once again, Michael, for being with us, and we'll look, hopefully, if you're available next week again, to get your updates on these key markets.
Thank you much.
Thanks so much.